Imagine you drive your car to a valet stand at a fancy hotel. You hand the attendant your keys. He gives you a ticket. Now, you assume that while you're at dinner, your car is parked safely in a garage. You assume the valet isn't driving it to Las Vegas. You assume he isn't selling your engine to pay off his gambling debts. And most importantly, you assume that when you hand him the ticket, he has to give you your car back. Not a similar car, not an IOU for a car, because that's how property rights work. Possession changed, but ownership didn't. Now, imagine you walk into a bank and deposit $1,000. You hand them the cash, they give you a digital receipt on your phone. You assume the money is in the vault. You assume it's safe. You assume it's still your money. And that is where you are wrong. The moment that cash crossed the counter, or the moment that direct deposit hit your account, a legal trapdoor opened. You didn't store your money. You didn't park it. You lent it. And the entity you lent it to, they are legally allowed to gamble with it, lose it, and in a worst-case scenario, refuse to give it back. Welcome to the fine print of the global banking system. Today, we are going to look at the terrifying legal reality of why the numbers on your screen don't mean what you think they mean. To understand how we lost ownership of our money, we have to go back to 1848, Victorian England, a time of top hats, steam engines, and a court case that changed everything. Foley versus Hill. A man named Edward Foley sued his bankers. He argued that the funds he deposited were his property, held in trust by the bank. He believed the bank was essentially a warehouse, a storage unit for his wealth. The House of Lords disagreed. They issued a ruling that became the bedrock of modern global finance. They said quite clearly that money deposited in a bank ceases to be the property of the customer. It becomes the property of the bank. The relationship isn't owner and warehouse, it is creditor and debtor. When you check your bank balance, you aren't looking at a pile of cash with your name on it. You're looking at an unsecured debt. You're looking at a promise. The bank is saying, we owe you this much. But here's the catch. You are an unsecured creditor. If a company goes bankrupt, secured creditors, like the massive hedge funds or other banks holding collateral, get paid first. You're at the back of the line with a tin cup, hoping there are scraps left over. So if it's not your money, what is the bank doing with it? This brings us to the mechanics of the black box. In the modern world, a bank is not a vault. It's a hedge fund that offers checking accounts. When you deposit $10,000, the bank doesn't keep that money for you. They keep a tiny fraction, historically usually around 10%, though in recent years, thanks to changes in reserve requirements, sometimes literally zero. They take your $10,000 and loan it out to a home buyer. Then they take that loan document and bundle it with thousands of others to sell to an investment firm. Then they use the proceeds to buy treasury bonds or bet on the direction of interest rates. Your money is in 12 different places at once. It's fueling a mortgage in Ohio, a tech startup in San Francisco, and a government bond in Japan. This is called fractional reserve banking. You've probably heard the term, but most explainers miss the danger. The danger isn't that they lend the money out. The danger is the duration mismatch. You want your money back instantly. You want to swipe your card for coffee now. But the bank has invested your money in a 30-year mortgage. They've promised you on-demand liquidity, but they've locked your cash in long-term assets. It's like the valet selling your car to buy a house, hoping he can sell the house fast enough to buy your car back before you finish your dinner. Usually, this works, because not everyone asks for their car back at the same time. But what happens when everyone does? We saw this in 2023 with Silicon Valley Bank. It wasn't a bunch of guys in trench coats robbing the vault. It was a run caused by bad math. SVB had taken customer deposits and bought safe government bonds. But when interest rates went up, the value of those bonds crashed. When customers came for their cash, the bank had to sell those bonds at a massive loss. The hole in the balance sheet got bigger. The panic spread. In the digital age, a bank run doesn't happen on the sidewalk. It happens in the cloud. $42 billion was pulled from SVB in a single day. Speed is the new risk.
The system was designed for a world where moving money required a horse and carriage, or at least a physical check. Today, panic moves at the speed of light fiber optics. But let's escalate the stakes. Let's look at the nightmare scenario. What happens if the bank actually fails? Not a little fail, a big fail. You're probably thinking, I'm fine. The government insures my money. In the US, that's the FDIC. In the UK, the FSCI. The limit is usually around $250,000. This is the psychological safety net that keeps society from collapsing. But have you ever looked at the math of the insurance company? The FDIC has a deposit insurance fund. As of the last few years, that fund holds roughly 1.2 to 1.4% of all insured deposits. Think about that ratio, 1.2%. If one or two regional banks fail, the insurance works perfectly. The neighbors cover the loss. But if there's a systemic crisis, if 5, 10, or 20 major institutions wobble at the same time, that insurance fund is a thimble of water trying to put out a forest fire. And the governments know this. They know they can't just print infinite money to bail everyone out every time, because that triggers hyperinflation. So, after the 2008 crash, global regulators came up with a new plan, a plan that's legally written into the rulebooks of the G20. It's called the bail-in. We all know what a bailout is. The government uses taxpayer money to save the bank. People hate it. It's political suicide. So, they invented the bail-in. In a bail-in scenario, the bank doesn't look to the government for help. It looks to its creditors. And remember what we established at the start of this video? You are a creditor. Under bail-in laws like the Dodd-Frank Act in the US or the BRRD in Europe, failing banks have the legal power to confiscate a portion of unsecured deposits and convert them into equity, stock in the failing bank. This isn't a theory. It has happened. Look at Cyprus in 2013. The banks were collapsing. The government and the EU decided that a bailout was too expensive, so they shut the banks down over the weekend. When they reopened, accounts with 100,000 euros had nearly 50% of their money seized. In exchange, the depositors were given shares in the bank, shares that were essentially worthless. Imagine waking up, checking your app, and seeing your savings cut in half, replaced by a notification saying, "Congratulations, you are now a shareholder in this bankrupt institution." That is the bail-in mechanism. It's the legal recognition that your deposit is a loan, and loans can default. This brings us to the irony of the modern financial system. We're constantly told to save money. We're told that cash in the bank is the ultimate safety. We view the stock market as risky, crypto as gambling, and real estate as volatile. But the one place we consider safe is actually a leveraged hedge fund operating on a razor-thin margin of error, where you have signed away your legal ownership rights in exchange for convenience. The system relies entirely on faith. It's a confidence game in the literal sense of the word. If we all believe the money is there, then the money is there. The moment we doubt it, the money evaporates. Because the money was never really money. It was credit. It was data. So what does this mean for you? I'm not telling you to pull all your cash out and bury it in the backyard. That's paranoid and impractical. You need a bank to live in the modern world. You need to pay bills, receive a salary, buy groceries. But you need to shift your mindset. Stop viewing your bank account as a personal vault. Start viewing it as a utility service that comes with counterparty risk. This is why wealthy individuals never keep all their liquidity in one bank. They spread it out to stay under insurance limits. They buy short-term treasury bills, which are direct loans to the government, bypassing the bank's risk. They hold physical assets. They understand that in a system built on debt, possession is 9/10 of the law. There's a famous saying in crypto, not your keys, not your coins. But the traditional finance version is older and much scarier. Not your vault, not your cash. The next time you log into your banking app and see that number, remember, that isn't your money. That's just how much the bank owes you. And hopefully, just hopefully, they have the liquidity to pay you back when you ask.